Welcome to this explainer, Asset Protection 101, The Mortgage Ally. We're jumping straight into the definitive guide on protecting your real estate assets from, honestly, total financial catastrophe in this crazy volatile 2026 market. We all know buying a house is just step one, right? But what happens after they hand you the keys? Today, we're treating your home not just a place you live, but as a complete, holistic financial architecture. By the end of this, you're going to have a rock-solid, lender-first roadmap to shield your wealth from market shocks, wild weather, and, even mistakes made by the very institutions holding your loan. Okay, let's dive into this. A 2 to 3 times multiplier. Just let that sink in. That is the staggering reality facing modern homeowners right now. If you're in a state like Florida or Texas, you've probably seen your annual insurance premiums double or literally triple just because of extreme weather losses. Insurance companies are bleeding billions in damages. And guess who foots the bill? You do. For some folks, these skyrocketing premiums are making it completely impossible to even afford to stay in their homes. It is a harsh reminder. If you aren't actively managing your risk, well, the market is going to manage it for you. Moving on to Section 1, the Insurance Mortgage Nexus. So these massive premium hikes have created what we call the insurance mortgage nexus. With costs this unpredictable, it is absolutely essential that your mortgage lender takes the lead on your proactive risk management strategy. Gone are the days of just buying a house and figuring out the insurance later. Today, you need a capital-first mindset. Your financing and your insurance oversight have to be architected together before you even think about putting an offer on a property. And that brings us to a massive pitfall here, the insurance gap. Basically, this is the dangerous financial void that opens up when your home is insured for its lower actual cash value, or ACV, instead of its current, usually way higher, replacement cost value, known as RCV. Look, homes appreciate, historically around 3 to 5% a year, right? So the cost to completely rebuild your house goes up too. If your policy only covers that ACV, a total property loss could literally bankrupt you because you just aren't covered for the true replacement cost. Closing that gap, that's your absolute first line of defense. Which leads us to Section 2, Protecting with Life Insurance. So this transitions us right into the next vital budgetary guardrail of our mortgage-led strategy. Your home is likely your family's biggest asset, sure, but a mortgage is also their biggest financial responsibility. If a primary income earner passes away unexpectedly, that sudden loss of income can trigger a full-blown foreclosure crisis for the surviving family. We have to build a defense against that, and this brilliantly illustrates the two main paths you can take. On one hand, we have Mortgage Protection Insurance, or MPI. This policy perfectly matches the declining balance of your mortgage, but, and this is key, the lender is the beneficiary. You pass away, the lender gets paid. The house is owned free and clear. But your family, they don't see a single dime of liquid cash. On the flip side, we have Level Term Life Insurance. This pays a fixed death benefit directly to your designated survivors, giving them ultimate flexibility. They can pay off the mortgage if they want, or keep the funds for household liquidity, especially if they're sitting on a super low interest rate they want to hang on to. All right, Section 3, Escaping the Disability Trap. We need to pivot to a risk that is actually even more statistically likely. Believe it or not, the risk of suffering a disability that stops you from working during a standard 30-year mortgage is actually higher than the risk of premature death, yet it is heavily overlooked. Protecting your income stream from a health crisis is just as critical as protecting the physical house from a hurricane. Now, what's really interesting about this slide is how clearly it maps out your actual options. Notice how mortgage disability insurance totally mirrors mortgage protection life insurance. It only covers your monthly principal, interest, taxes, and insurance, and yep, the lender is the ultimate beneficiary. Great for preventing foreclosure, but its flexibility, incredibly low. If you rely solely on mortgage-specific disability, it leaves your family totally stranded without comprehensive support for groceries, utilities, and everyday lifestyle expenses. So you might be sitting there thinking, hey, I've got disability insurance through my job. I'm good. Well, look closely at this comparison. High-income professionals, in particular, often fall into a massive income gap here because employer-provided group plans usually cap your monthly benefits. And those caps, they are rarely enough to cover a modern mortgage alongside normal living expenses. This is exactly why porting a supplemental individual disability policy is a total necessity. They are non-cancelable, they move right along with you if you change jobs, and they actually provide the true household support your family is going to desperately need. Let's jump to Section 4, Managing Mortgage Servicer Struggles. Let's shift gears to the operational nightmares of asset protection. We've talked about protecting against weather, death, and disability. But what happens when the threat is actually coming from the institution managing your loan? The reality is, most U.S. mortgages are managed by just a handful of massive servicing companies, and when loans are sold or transferred between them, catastrophic miscommunications can and do happen. To really ground this institutional threat, let's look at Arlene's story. Arlene is a 70-year-old homeowner. She successfully modified her loan, was diligently making all her payments, doing everything right. But when her loan gets sold to a new servicer, this new company completely misapplies her payments. Out of nowhere, she's getting slammed with late notices, and her credit is actively being destroyed by the bureaus. It is a very real and honestly terrifying threat of post-closing servicer errors. So the crucial point is, fighting these massive servicing companies feels exactly like hitting a brick wall. Once those payments are misapplied and the automated late notices start flying, you absolutely cannot rely on a quick fix from customer service. Fighting these institutional miscommunications means you have to preserve your household liquidity. You need those emergency cash reserves so you can outlast the dispute process without defaulting on your other obligations, or worse, losing the property entirely while the bureaucratic mess is getting sorted out. Finally, Section 5, the annual homeowner audit. A true mortgage-led strategy absolutely does not end at the closing table. It extends way out into the proactive management of the asset over time. To stay ahead of market volatility, skyrocketing insurance premiums, and those servicer errors we just talked about, you have to execute an annual financial tune-up. This is the ultimate proactive wealth management maneuver. Let's move to the steps and see how this builds a truly impenetrable shield around your real estate portfolio. Step 1. Do an equity check and scout for refinance opportunities. Also consider setting up biweekly payment drafts, because that really accelerates equity growth. Step 2. Review your property tax assessments. These can shift without warning and drastically alter your monthly escrow payment. And finally, Step 3. Verify those replacement cost coverage limits we went over earlier. You've got to ensure your insurance policy is keeping pace with the true cost to rebuild your home today, not what it cost 5 years ago. Executing these 3 simple steps every single year is exactly how you guarantee long-term solvency. I want to leave you with a defining question for this 2026 market. Look, anyone can sign a stack of papers and make a monthly payment to a bank. But truly successful homeowners adopt a capital-first mindset. They understand that insurance mortgage nexus, they proactively shield their income from disability and loss, and they audit their assets every single year. They treat their home like the holistic financial architecture it actually is. So ask yourself, are you just paying a mortgage, or are you protecting your wealth? Thanks for hanging out with me for this explainer, and I really hope this empowers you to take absolute control of your real estate wealth.